What is up, YouTube? Welcome back to another video. Thank you for joining me today. I'm your host, the Dividend Aristocrat, and today we're going to be talking about my best and worst positions of 2023. While we're here, I thought we could take a quick glance at my portfolio dashboard. As you can see, I'm actually down since last time I posted. It is 2024. I'm recording this video early 2024, and a lot of the stocks are down. The market as a whole is down a little bit, so that's been affecting our total return, but we're still sitting pretty, and I look forward to getting some dividend income this month. All right, and without further delays, let's take a look at my biggest winners. My top three are Intel, Microsoft, and Tesla, followed closely by Amazon and Google. And of course, an honorable mention to Apple because it was sitting right up there with the rest of them, but it has tumbled down in the past week and a half. So looking first at Intel, we can see here my average price paid was $27.30, with the current price sitting at almost $47 per share. I have a very small position sitting at about $82 with a current value at $144. I've seen some amazing growth with this company within the past year alone, up around 76%, but at my peak, Intel was actually sitting at a 90% gain. So it's definitely tumbled down a little bit since the new year, since I'm recording this after the new year has ended. But during 2023, I was sitting very pretty on this position. My total dividend earns are only $22.24. It was supposed to be higher than that. When I bought this position at first, it was yielding about 5.5%, but I think literally within a matter of days after I bought it, they announced the dividend cut that they were going to be making. So that was a little unfortunate, but that's okay. Hopefully the company will be healthier after the fact. The yearly dividend is 70 cents per share, or an annual payout of $2.15 across all my three shares. The yield is sitting at 1.49%, and the yield on cost is 2.56% because I bought it at a lower valuation than what it's sitting at right now. And my total allocation for this position is only 0.5%, which I'm fine with, but it would have been nice getting it above 1%. That way at least it would be more substantial. And jumping into Seeking Alpha, we can see Intel Corporation graphed against the S&P 500. What I went ahead and did was actually graph from January 1st, 2023 to December 29th, 2023. The reason I'm doing this is because when I'm recording this video, it's actually already the second week of January almost. So this gives a more accurate representation of the performance for 2023. So taking a look here, it has some rough times at first, but coming towards the end here, it definitely beat the S&P 500 by a lot with a maximum total return of like 93%. And if you would have bought it here at this low, you actually would have had an even higher total return. So I definitely was sitting close to this before, but right now it's a little bit lower than that. And jumping right into my second biggest winner, we can see that it is Microsoft. The average price paid is sitting at $231.78 with a current price of almost $370. Also, guys, I did zoom in a lot this time, so hopefully you can see the numbers better. I know it was a little small on the previous video, so I hope this actually fixes that problem. It's about the most I can zoom into my holdings section. I purchased 4 shares total. I really wish I would have purchased more. I bought it at a very, very low price. Pretty rare to find Microsoft at these kinds of prices, but I only bought $927 worth. My current value is up a lot at $1,500 with a percent change of 61%. That's about the max that I've been at, maybe a little bit higher by a percentage point or two, but not much more than that. And looking at my total dividends earned, I've earned almost $14 from this position within the past year alone, basically. That's a yearly dividend of $2.93 per share, or $12 total across all the shares. But it has a very small dividend, but the dividend growth rates are very nice, usually double digits. The most recent one, I do believe, was at 10%. My yield is 0.8%, and my yield on cost is sitting at right around 1.26% since I bought it at significantly lower prices. So I'm definitely happy to hold it at these rates. It's about 4.7% of my portfolio, which is a good number to have it at. Most people don't want to hold any position that's over 5%. I wouldn't mind having Microsoft closer to 10% perhaps of my portfolio, but it's okay because I have a large holding in the S&P 500, and that's just more Microsoft shares for my portfolio. And taking a look at Microsoft versus the S&P 500, we can see that it very easily beat the S&P 500 this year. It had a great total return sitting around 58% for 2023, which is crazy. Definitely lower than Intel, but it's been a more consistent performer if you've seen its total performance over the past 5, 10, 15, 20 years, etc. I'm looking forward to seeing how this company performs in 2024. I wonder if we can keep this upwards trend going, if we can keep being the S&P 500. They're a great company with a subscription service, which has been generating them a lot of money and a lot of free cash flow. And taking a quick look at Tesla, average price paid of $156, and it's currently sitting at $240. It was actually sitting significantly higher before, but I only bought 2 shares of it with a total gain of around $161 at the moment. And like I said, before that, I think I was up around 80 to 90% over the summer, but right now I'm sitting at 51.64% because Tesla's been having a bit of a hard time kind of climbing back up. It's been going up, coming back down, going up, coming back down. The yield is 0%, so nothing interesting to see there, and it's 1.5% of my portfolio. I wouldn't mind it at 2% of the portfolio, but definitely don't want it much higher than that. I'm not a Tesla bull, never have been, probably never will be, so I don't plan on adding too much more to this position. I just thought it was at a good valuation. So Tesla's graph is completely absurd. As you can see here, I didn't buy it at as low of valuations as what this would entail. I bought it beforehand, so I didn't have this crazy increase of 130%. Like I said, our maximum return was sitting around 80%. But if we're looking over here, I mean, it was up 170% at one point or another, and then towards the end, still beating the S&P 500 by a lot at 141%. This is one of the most volatile stocks when the S&P 500. It has a huge market cap weighting, but it still moves a ton. I'm excited to see what Elon Musk can do and what this company is going to be doing in the future. I want to see what 2024 holds for it. I think it's going to have some rough time. The Cybertrucks have not been selling that well and have been having some problems, so I'm not sure how profitable it's going to be for the company, and their margins are not really where they need to be for investors to be satisfied. And for our honorable mentions, we have Amazon and Google. Both of them I bought at pretty similar prices actually overall. I was dollar cost averaging a little bit into Google. Amazon, I just bought 3 at the same time when it dropped to 99. It would have been nice to pick up more of these in hindsight, but I am sitting at relatively small positions for my portfolio, but with pretty big growth rates of 45% each, 43 for Google, but it was a little higher than that a bit ago. And then the dividend is 0. I am a dividend investing channel. For the most part, I focus on dividends, but I do focus on total return at the end of the day. And I think there's good quality companies at great prices. I definitely will buy them even if they don't have a dividend, though dividends are my preference. And then taking a quick look at Apple, I just want to shout it out because I bought a decent position in this one. I'm pretty happy with how much I bought of it. Would have, again, been nice to have some more, but not going to complain about this one at all. It was up almost 45% at some point, so it's not fair not to include it in this video. But right now it's sitting at around 33% return because of the bad news with the Apple Watch and the patent issues they've been having. They had to pull it back for now. So we'll see how they recover from this. They're a pretty strong company, so I hope they'll be fine. All right, and then let's quickly jump into my worst performing stocks of the year. The big ones here are Northrop Grumman Corporation, MO, which is Altria Group, and 3M. Starting off with Northrop Grumman, I do really like this company, but I think I just bought it at a little bit of a high valuation. They've been having a bit of a hard time keeping those prices, or I guess the price in the stock market, up. So I only purchased one share. It was a bit of a good chunk of money when I had first bought it, so it was $440. And I can only buy whole shares with Vanguard. Can't do fractional shares, unfortunately, for these companies. So I only bought one, sitting at a total return of 6.8%. That's not bad, but it's one of my rougher positions. And the dividends have been pretty low, so $3.75 with the dividends earned so far, with a $7 yearly dividend. The thing is, the yield is a little lower, but the growth rates for Northrop Grumman actually seem better than a lot of the other defense contractors. So I'm going to keep holding this position for now. I still do like the company. I just want to see where they go from here. And starting off with our negative performers, we have Northrop Grumman with a whopping negative 12% total return. If you guys remember, I was actually positive on this position, some of it because of dividends reinvested and others because of the price I bought it at. But overall, it's had a terrible year, getting destroyed by the S&P 500 by a whopping like 30%, 40% plus. So definitely has a lot of recovery to do. We'll see if it can bring it around back in 2024. And then taking a look at Altria Group, we can see I bought it at an average price of $43.29, and the current price is lower. If you guys are wondering what this highlighting is for, I just have conditional formatting showing me how close I am to my buy price. So the red means that I'm either lower or right around the buy price of how much I paid for it. So that way I know if maybe something is approaching my cost basis. And the yellow, of course, means that it's a little higher, as you can see here, my buy price, but not too high up to where I might still want to buy some more. So Altria Group has had a bit of pullback this year, hasn't had the greatest year. I still like the company a decent amount, but not planning on investing anymore. Doesn't have the total growth that I'm looking for, but I thought it'd be fun to add some high yielding positions just to change up the portfolio a little bit. I hold 22 shares sitting at a value of around $1,000, I guess a little under. But I have seen a drawdown of 1.46%. That's including dividends reinvested. Without the dividends, I would actually be a decent chunk lower. So it's nice because I've earned $27.34 so far with dividends. And I have a yearly dividend of $3.83 per share, which equates to $86 total each year that I can expect to be paid from Altria Group. My yield on cost is lower than the current yield you could buy it at. And it's about 3% of my portfolio. I definitely don't want it any higher than that. Altria Group ended up trading pretty flat for the year in the end. I mean, price-wise, it's actually significantly lower than this, but with dividends reinvested, it's sitting at negative 3.3%. I'm not going to show the price return just because I do reinvest my dividends, so I think it's more a fair comparison of what it would actually look like for me. And my biggest loser of the year is 3M. I'm sure you guys know about all the legal issues that they've been having, so $124 is what I bought it at. I already thought it was a low price and a good valuation, but it's just had a harder time since then. It actually dropped all the way down to like $91 at some point. So the maximum drawdown it was way lower than what it's sitting at right now. I purchased one total share. I am thinking of liquidating this position. I do think they're going to recover pretty nicely, but I just don't want to hold random stocks for no reason. So a $124 position doesn't really do anything for me the way I see it. Thanks to the dividends that have been reinvested so far, I actually haven't lost too much money in the position, $7.70 total earned of dividends, and I can expect to make about $6 per year continuing forward. And 3M, by far my biggest loser. We can see that with dividends reinvested, it was only down negative 5% for the year, but it has been decreasing actually for a couple of years now. So my negative returns have been accumulating for a little longer than that. I am looking forward to seeing if they can turn around in 2024. I think it is time for a redemption run for 3M, and I think they have a good chance, but I'm not sure if I'll stay to witness this run up or if I'll sell out instead. And then two other companies I want to mention real quick are PayPal and Target. I am positive on both of them, but I don't think that's fair necessarily because of the way I bought them. So PayPal is actually down a significant amount, which we'll take a look at in a second for the year. But my position itself, since my average buy price is pretty low, I'm actually positive in the green, about 12.55%, which is good. So we'll see where this company goes from here. I think it has potential to recover a decent amount. Nothing crazy like what Meta had, but it still has a good opportunity to do so. And then in regards to Target, I bought Target at like 145, and I think I maybe bought another one at like 160. I can't remember exactly because it was climbing up, and then the stock tanked completely. It went all the way down to I think $100, somewhere around there at its lowest. So I did actually buy some more in the end when it was lower, which kind of helped me lower my cost basis. But if I had kept that current price of 145 that I originally bought it at, then I would definitely be in the red still today. But looking at my total return, I'm actually staying at 15.53%. And that's thanks to, of course, the dividend, which I've earned already $14 from it. And then my yearly dividend will continue to pay me $26 a year. And the fact that I bought it while it was going down, so that kind of helped me out a little bit. And taking a quick look at Target's 2023 performance, we can see here what I mean. It ended up pretty close in the end to flat at minus 3%, which is still very bad compared to the S&P 500. But if you see down here, it was down about 28% at one point or another. And without dividends reinvested, this would be even lower than that. So it had a pretty rough year. And PayPal is actually a great example to look at because, as if you guys remember, I was up 12% so far on my PayPal position. But if you look right here, 2023 ended up being down 17%. And at some of its maximum points, it was down over 31%, which is very bad. It had a rough year. It's been having a rough couple years, actually, and still trying to recover. We'll see if it can turn around in 2024. I would love for that to happen, of course, as a shareholder, but not sure if that's possible anytime soon. And before I end this video, I did want to talk about a comment left by one of the viewers. He asked me what I do about FOMO and how I deal with that kind of stuff. So a lot of my decision making actually comes just from buying good quality companies at fair valuations. I'm sure you guys have heard the quote before, but you'd rather buy a good company at a fair price than a fair company at a good price. So overall, I'm not just looking for cheap prices or the cheapest stock possible, but I'd rather buy a company that's doing well already, but maybe has some drawdown, kind of like what we saw with Apple, Microsoft, Visa, MasterCard. I mean, these are amazing, great quality companies that had a bit of a pullback because of some sentiment or some negative earnings. And I think it's a great opportunity to jump into the market. Also, one thing that helps me not have FOMO is to dollar cost average what I can. So with my ETFs, I do try to dollar cost average as consistently as I can, though lately I have not been doing so as much because of the high valuations in the market. I also find that it helps to set price targets ahead of time for certain stocks. So for example, I'm looking to buy United Health at a buy price of around 500 or less. So as long as it's sitting above it, yes, I have FOMO because I really want to buy the company. But at the same time, I'm not going to go rush in to buy it just yet because I do have a standard of when I want to buy that. And another great example we can look at is for Apple in 2022. I was actually saying that I'm going to buy it anytime it drops under 140. And when it dropped under 140 eventually, it's actually when I started buying into it. And I bought it all the way down to $130. I dollar cost averaged into it. And that ended up paying off immensely for me. So I think one thing you guys have to consider is that if you wait for the opportunities, they will probably come. That doesn't mean you should sit on the sidelines your whole life or just wait for stocks to drop a crazy amount. But if you have some idea of what you want, don't be impatient, and the opportunity will continue to present itself in different ways. I feel like there's always some sort of catalyst to push a price down, or of course some sort of catalyst to push a price up. Also, I assume that most of my viewers are like me and have a fairly long time horizon. Something to consider is that the longer you invest the money in, the more time you have in the market, the less it matters what price you bought it at and just how consistent you are with investing into that position. I also try to buy lower yielding positions like I talked about before with higher potential dividend growth rates. This way, even if the position is yielding just a little bit at first, my yield on cost will grow and the snowball effect will accelerate over time. My main goal is to maximize my total returns in the portfolio and not the dividends themselves necessarily. I hope this information clears some stuff up and helps anybody that might have similar questions. I don't mind sharing more, but let me know and I can definitely share them in a future video. If you guys have any recommendations on future content you want to see on the channel or any recommendations for my videos, please let me know down below. Also, comment your biggest winners and losers for 2023. I'd love to know how you performed this past year. Other than that, I really want to thank every single one of you for tuning into this video and checking it out till the end. It really does mean a lot to me. I'm going to keep posting consistently on this channel, so stay tuned for more videos. Thank you guys for watching, and I'll see you in the next one.